Let's unpack some of the wealth features of permanent life insurance when we're talking about protection, transfer, access, and building. I mentioned cost. Everything has a cost. Financial institutions are banks, they're investment companies, they're also life insurance companies, all right? Everyone is in business in order to provide solutions for a cost. There's trade-off costs. There's also cost hurdles, like when you invest in whole life policies, you have surrender charges. What does that mean? When you try to access your money too early and withdraw it within a window, say 5, 6, 7, even up to 8 years, first 8 years of the policy, you may be charged a percentage for accessing your money. So taking a haircut off the money that you placed in there. So you're also having a time cost because before you're able to compound on your money in a whole life policy, you have to let it, meaning your money, grow for a time period and stay invested without early access. Then the magic of compounding begins to work after a certain time. So you must have funds in that earlier period to avoid being illiquid and when you need money at a particular time. All right, so let's also talk about time and funding. Time and funding, more than likely you're going to have to fund whole life policies with premiums. These can be a little large and a little hefty, a part of your cash flow when you need to fund and have cash flow in other areas. And when you're talking about whole life insurance, which is a form of permanent insurance, you're paying premiums for your whole life unless you have a paid up policy. Okay. So you want to be able to have time to fund a whole life policy over time so you can get to that compounding. Another way to do it is if you had a lump sum payment through an inheritance, or you have accumulated a wealth amount to place a lump sum amount in a permanent policy. That's when you could really start taking advantage quickly of your policy when you're talking about access. Let's talk about access. When folks are saying be your own bank and infinite banking, they're talking about borrowing against your wealth. Remember, when you're borrowing your wealth, you want to be borrowing to build, because when you loan or borrow money from your policy, you're paying an interest rate. You have to pay that back. It is a loan. You're either paying it through the death benefit or you're repaying it out of your pocket before you pass. Okay, so borrow to build. If your why is not leveraging your wealth in order to build something to outpace the cost of your policy, then there are other features, as I mentioned, that you can fund that'll help your money grow over time. Those other accounts, solo 401ks, employer sponsored plan, your HSA, your taxable brokerage account. You can do other things to build wealth. If your why is to build businesses and build investments inside your portfolio, then you can have great access that you don't need an institution to qualify for. So it's very efficient, and ding, ding, tax-free borrowing. You will not pay tax when you access money from a whole life policy. That's what people are talking about infinite banking. But if you're not borrowing to build, and far as businesses to outpace your costs, then you can invest in other things and other tools to help you on your wealth building journey.